Today, reading the economic tea leaves. Hello again, it's Martin North from Digital Finance Analytics, one of the latest posts covering finance and problem news with a distinctively Australian flavour. So the RBA left the cash rate on hold today, as expected. And frankly, there was very little new in their release today. Of course, they're hoping that things will turn around, and essentially, reading between the lines, they're hoping that the lift in property values will translate to higher household spending ahead, but we have our doubts. I think the chances are we're going to see interest rates cut next year, and of course that leaves the door open to quantitative easing later. But the stock market today fell 2.19%, and whilst this may have to some extent reflected the RBA's news, I think it was more to do with Trump and trade, because overnight Trump announced that he would impose tariffs on France because they have threatened a digital tax on US companies. And he also followed up on trade issues in South America, particularly around metals. And there was also talk that if China didn't come to the table, then tariffs would be lifted later in December. So the atmospherics around the trade talks definitely turned negative, and that impacted share markets around the world, including Australia. So the ASX 100 finished the day down 2.19% to 5,568. Looking at some of the other indices, the ASX 200 financials fell 2.13% to 5,966. In fact, all of the banks pretty much fell. But the volatility index, on the other hand, rose. It was up 17.06% to 1343, signalling, of course, greater concerns and more worries about the risks in the system. Amongst the major banks, ANZ was down 1.08% to 2472. CBA was down 2.57% to 79.34. NAB was down 1.81% to 25.43. And of course, the new CEO, Russ McEwen, has now started at NAB. And there was also some gossip today that maybe Austrac will be looking quite seriously at NAB following their recent outing with Westpac. And talking of Westpac, Westpac was down 1.26% to 24.29. Amongst the regionals, the Bank of Queensland was down 2.59% to 7.53. Bendigo and Adelaide Bank fell 0.8% to 9.91. Suncorp fell 2.1% to 13.05. And Macquarie fell 2.45 to 134.77. AMP fell 3.84% to 188, and it was announced today that they'd lost a major mandate with regard to superannuation. So the bad news for AMP just continues. Genworth, the mortgage insurers, fell 0.82% to 364, but McGrath rose 10.45% to 37 cents, I guess, because the assumption is that with home prices rising, they will do better. But remember that the transaction volumes going through the real estate sector are very low at the moment, and frankly, listings are still very low, so it's unlikely, I think, that they're going to do particularly well going forward. Yellow Brick Road was at 7.9 cents. Mortgage aggregator AFG was up 1.98% to 258, while Mortgage Choice was down 7.58% to 128. So aggregators up and aggregators down. Now the Aussie US dollar rose 0.45% to end at 68.47, which is a significant rise, and that's because the US dollar was weaker because of those trade concerns, and the fact that the Reserve Bank kept rates on hold today, as expected. And whilst there is still a prospect of rate cuts later, for now, the Aussie looks slightly better value. But we'll see how long it holds up. The Euro Aussie dollar was down 0.38% to 161.87. The Aussie Gold Cross was down 0.36% to 2,137.07. And the Bitcoin Aussie Cross closed at 10,748. Now, the other important news today was that Australia went back to back with a current account surplus, and that's the first time in 46 years. The largest quarterly goods and services surplus on record was 21.1 billion, and there was a narrowed net income deficit of 13 billion, which contributed to Australia recording a seasonally adjusted $7.9 billion current account surplus for the September quarter 2019. For the first time in 46 years, we've had 2 consecutive current account surpluses, strong export volumes for non-monetary gold, reflecting global geopolitical developments, whereas iron ore and liquid natural gas have shown sustained high export levels, with LNG exports in particular reflecting the production impact of the mining boom. And volumes remained steady for imports overall and resulted in an increased September quarter trade surplus. And in seasonally adjusted chain volume terms, the balance of goods and services surplus increased $1 billion, widening the surplus to $9.3 billion, with an expected contribution of 0.2 percentage points to growth in the September quarter 2019 gross domestic product. Now, the other point to note here is that Australia's net foreign debt liability position increased $20.4 billion to $1.16 trillion. That's the biggest it's ever been. And that means that we are very exposed, of course, to the international climate, and particularly should global liquidity freeze up. And a significant proportion of that is on 90-day terms. So this could actually become a significant issue quite quickly. So if you put all this together, the export engine is still firing relatively well, but with weaker commodity prices ahead and potentially weaker demand if international trade disruption continues, it's going to be harder to maintain that momentum. Now, tomorrow we'll get the GDP number, and so we'll be able to take a read on whether in fact we are looking at a recession or not. Given the strength of the export numbers here, I suspect that Australia is going to dodge that recession bullet, but we'll see. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.